Hello and good afternoon, everyone. Welcome to LSEG's webinar for this afternoon. It's on exploring deal-making trends in Asia Pacific. My name is Katharina Ginto Roldan. I'm the Director for Asia Pacific Contributions, and I will be your moderator for this afternoon. My colleagues will be joining us later today to cover the rest of, the actual presentation for today. Look forward to Elaine Tan. She is the Senior Manager for Deals Intelligence covering Asia Pacific and Japan, and she will give us insight into the deal making world across the globe and, of course, specifically for our region. She will also give us a deep dive into the world of M&A for Asia. And then right after Elaine, we will have Daniel Stanton. He is the editor for IFR Asia, and he will give us insights into the world of capital markets in Asia Pacific. So again, welcome. Before we begin with today's session, I would like to cover a few things. So the first is that the session will be recorded. Second, there is a Q&A window or a question box and you can just press it on the upper right hand of your screen in case it's not showing on your side. And please key in any questions that you have or any topic that you want to make sure we're going to cover for this afternoon. We've also prepared several resources for you, so you can go to helpful resources again on the right hand side of your screen. And when you check that, there will be various resources you can refer to, and that. Of course, right after the session, we will be recording it and you can view it for today. So, what are the expectations? We just like any of our previous webinars, we'd want this to be an interactive session, meaning we won't be the only ones talking. We cannot open the mic during the session for all of you, but we don't want you to just listen in. So there will be two ways for you to actively participate. Again, the first one I mentioned about the Q&A. So please, again, prepare your questions, send them in, and we will be managing it right after the presentations. And number two, there will be poll-in questions for today. So there are four for the rest of the sessions, and hopefully you will wait for them and hopefully you will participate. So with that, I think we can get started. For the first portion of the webcast, we're hoping to know what are the demographics of those that are joining today's call. Who is our audience? So the first question is, please tell us which function you work at. Are you from the mergers and acquisitions world? Are you part of equities capital markets or ECM, or the debt capital markets or DCM, doing general coverage, or others than the ones that I mentioned earlier? So again, are you from M&A, ECM, DCM, general coverage, or others? So we're just waiting for the answers to come in so that we know, where everybody is coming from. Hmm. So we're not getting a lot of answers yet. So let's give the others a few more. Yeah, time. So for those of you, again, the question is which function are you at? Which function you work at? M&A, ECM, DCM, general coverage, or others? So right now, I'm only seeing general coverage and others. Oh, so there's one for M&A. Okay. Okay, getting more responses right now. Okay. So I think there's more on the either general coverage or others. It's like head to head there. So welcome everybody, and again, thank you for joining us in this afternoon session. So just wanted to give you a general overview of what we would be expecting, the things that we're going to cover for today's agenda. Last month, about 3 weeks ago, Matt Toole, Lucille Jones, and Christina Stavro kicked off the Global Investment Banking webinar. And today, we wanted to touch on a few of those global overview, but of course, we will take a more closer look into what's happening in our region in Asia. But before that, I think I'm seeing more and more people who's just joining in for today's presentation. There is a poll number two, and hopefully you guys are ready to answer that. So, which factor do you think will have the most significant effect on overall corporate finance activity in 2024? So, guys, we are on our poll number two. the question again is which factor will have the most significant effect on overall corporate finance activity in 2024? Will they be interest rates? B, geopolitical tensions? Will they be recessions, corporate confidence, or elections? So, in your perspective, what do you think will have the most significant effect for this year? Interest rates, geopolitical tensions, recession, corporate confidence, or the elections? Very interesting answers. Keep them coming, guys. I think this is going to be very, very important for us. And I'm hoping that whatever we hear or whatever we get from the poll questions, we will see like how Elaine and Dan will be able to cross-check it, from the data that they saw during the last 6 to 7 months in at the beginning of the year. So again, the question would be: do you think it would be interest rates, geopolitical tensions, recession, corporate confidence, or the elections? Interestingly, I'll share with you while we're waiting for the other answers to come in. In the global webinar, most of the attendees said it was seems to be more like a 50-50 for them, both on the geopolitical and the elections. And looks like for us, it's more of geopolitical tensions. So yeah, very similar to what the global attendees on the global webinar answered. There were, geopolitical and elections because this year was the election year. I read that about 50 countries conducted or are conducting their elections within 2024. So definitely there's a touch of both politics and the election. So that's why there's a close. Oh, so now it has changed. Interest rate is also now they're on a tie with global political tensions in Asia. But last number. So right now is global global tensions. Okay, so thank you again, everyone, for keying in your answer. We're looking forward to understand like how did the deal making activity and this expectation for the market in Asia. Again, your perspective is that it's the geopolitical tensions. How does it translate into our investment banking fees and total activities for so far this year? So for M&A, based on the first 2 quarters of the year, according to our global review, M&A activity globally has increased by almost 20%. But for us in Asia, it seems the first half of the year is on a downward trend. So Elaine, I am really, really looking forward to hear your insights on that and maybe help us understand better where we are going. And then, of course, please touch on some of the things that we should be highlighting on the global investment activities. And are you seeing any changes into the trend after the first half of the year? And with the slow start for the region, did we see any improvement in deal making activity during the second quarter of the year? So go ahead, Elaine.
Thank you, Thad, for the introduction, and thank you, everybody, for joining us today. As you said, it's quite exciting times. Start of the year for M&A, well, at least in the US and the Europe. But, before we get into that, let me share some high-level trends. Overlooking at overall IB fees that was also shared by my colleagues during the global webinar to start off. I guess if we could just move on to the first slide. This shows an overview of where we stand in the world of deal making and investment banking during the first half of the year. But to take note, for the rest of the presentation, we will look at more recent data up to the end of July. So as the global macroeconomic picture, dynamic interest rates environment, and many other factors come into play in the investment banking world, there's always a mix of different stories across asset classes and across regional aspect as well. So globally, investment banking fees totaled 58 billion in the first half of 2024. It was up 7% increase from a year ago. You'll see the chart on the left showing the first half volumes of global IB fees. We are now at the fourth highest year-to-date total since our records began in 2000. During the start of, well, at least the first half of the year, M&A fees based on completed deals were up 3% compared to a year ago. DCM fees also increased 13% year on year, driven by corporate bond market. Syndicated lending was up 3%, and ECM fees declined 6%, driven by the overall decline in IPO activity. But if you look at the overall average over the past 10 years, we are actually right above the 10-year average, taking out the all-time high in 2021, as you can see in the chart, which will always be an outlier. That's the year when we just saw everything coming together, providing leading investment activity to reach an all-time record in most nearly every asset class that we tracked across every region. So it's interesting to see as well the dynamics across the region. Americas was up 23% compared to a year ago, of course, with the United States being the main driver for both M&A and capital markets activity. European IB fees was up 12% from a year ago. Asia Pacific was down 24%, and Japan fees were up 8% from a year ago. And, we're always continuously monitoring that interplay between Europe and Asia as contributor to the global fee pool, which has been moving back and forth over the past few years. Since the financial crisis, Europe has been on a sideways, almost flat movement, while Asia's been climbing upwards as fees continue to grow in the region. And at some point we see that Asia's taken a larger share of the fee pool versus Europe, as you see that intersection between the Europe and Asian line. Of course, China has been a big contributor to Asia's fee pool, but that has been a largely captive fee pool, and there's not a tremendous amount of global cross banking. And we continue to anticipate how this plays out for the rest of the year. Now, if we move on to the next slide, we'll look at Asia Pacific investment banking fees in major markets. So looking closely at Asia, the region generated over 9 billion investment banking fees for the first half of the year. That's down 24% from a year ago. And it's the third decline after witnessing the strongest first start period in 2021 and the lowest first half period since 2017. At least 75% of the Asia Pacific fees were from equity and bonds underwriting, and completed M&A around 10% of the wallet share. Equity capital markets underwriting fees reached around 1.6 billion. That's down 52% year on year. It's the lowest first half period since 2013. Bond fees dropped 4% from a year ago to 5.6 billion, while syndicated lending fees declined 34% from last year. And then advisory fees earned in the region from completed M&A transactions reached around 989 million. It's down 25% compared to the first half of last year. There were very few mega deals for Asia this year, so it'll be interesting to see how this will affect the M&A fee trends in the coming months ahead as deals are completed. Just a quick look around major markets in the region. It's an overall decline except for a few markets. So China, which has brought in 60% wallet share of the regional fee pool, it's down from 67 wallet share last year. And for global wallet share, it captured 10%, and it's down 16% from last year. So China follows second to the US, which captured 47% of the global IB fees so far this year. Majority of the markets in Asia witnessed year-on-year declines, with certain pockets in the region seeing some growth in terms of fee perspective, such as Australia. We've seen 1.4% growth, mostly from capital markets, as well as Japan, a 7% increase year-on-year, also from capital markets, and a few complete M&A fees grew as well. That I think we're moving on to the M&A activity. Do you have any pause? Not yet? Okay, so let me move on to the global M&A activity. So if you can move on to the next slide, please. So just before I dive into the Asia Pacific M&A activity, I wanted to zoom out a bit and share the global landscape first before I dive into the region's activity. So we saw a really strong start of the year. we did lose some of momentum, and there were signs of a weakening around Q2, even if financial conditions have generally improved. The expectations for rate cuts has changed, with interest rates remaining higher for longer than anticipated, with the upcoming elections, as Fed mentioned, macroeconomic uncertainties, increased execution risk, that has made the market a little less positive now compared to the start of the year. So announced M&A reached around 1.8 trillion during the first 7 months of 2024. It's up 16% compared to a year ago, despite a 25% decline in number of announced deals. And then in the month of July, we saw 246 billion M&A transactions, and it's 10% more than the value recorded in the previous month and 6% up compared to the same period last year. From a regional M&A activity perspective, if we can just show the next slide, please. So this will show us the breakdown of the target M&A activity across the globe. So it shows the breakout between the main regions. As you can see, almost all saw double-digit growth based on target M&A, except for Asia Pacific and Japan. We'll get to that later. So deals involving Asia Pacific, Americas, it surpassed $1 trillion mark during the first 7 months of 2024. It's 2 months earlier than last year, when it took until September to reach this particular milestone. And of course, the US dominated, with deals involving US targets accounting for 51% of overall global M&A activity. And it's the highest year-to-date share since 2019. But, I think we saw 20 large deals all coming from the US, or 20 of the largest deals were coming from the US. Majority were mostly US domestic deals, actually. And then European M&A totaled 397 billion for the first 7 months of 2024. It's up 36% compared to last year, and again, driven by the United Kingdom, which accounted for 29% of the total. And that's the highest share of deal making in the region in 3 years. So UK targets totaled around 113 billion. It's making UK the second most targeted region for M&A globally, after the US. And target Asia Pacific, as I mentioned earlier, it's Asia and Japan were the ones that saw some declines. So it's down 18% to an 11-year low of 282 billion. And it's really driven by the slowdown in target China activity, as it declined 27% compared to the 7 months of the same period last year. So as I mentioned, we've seen a lot of mega deals this year. I think 20 deals worth 10 billion or more were announced globally during the first 7 months of 2024, compared to only 15 from the same period of last year. And 13 of that were actually announced during the first quarter of this year. But and just one was announced during the month of July, and it's the lowest monthly total in 18 months. So many levels have been quite choppy the last few years, from the post-pandemic deal-making frenzy in 2021 and into the first half of 2022. And then there was that big downturn in M&A activity, which also progressed until the 2023. Actually, last year was the first year we failed to reach the 3 trillion mark in a decade. And it was also the first time that we've seen 2 years of consecutive double-digit percentage decline in M&A since the financial crisis in 2008, 2009. So it's been a very challenging environment for M&A. Lots of headwinds putting on the brakes on deal making, from as some of the themes that Ted mentioned earlier: geopolitical tensions, interest rates, recession fears, market volatility, right, rising inflation. They have all brought instability and uncertainty, and that does have a big impact on M&A activity. And it affects the confidence to take these big risks, and investments became more subdued, and these factors really dampened the appetite for deal making. Now, moving on to Asia. So if you can move on to the next slide, please. So a closer look at any Asia Pacific involvement M&As. Earlier, the figures I mentioned for Asia was target Asia Pacific, so all deals targeting Asia. But this one, from an overall perspective, we are looking at the overall deals involving Asia Pacific, not just target, but also as acquirer, investor, or seller up to ultimate parent level. So while mega deals have pushed the global trend at the start of 2024, deal making involving Asia Pacific, excluding Japan, during the first 7 months of this year actually fell to more than a decade low, down to 19% in value compared to the same period last year, with only 329.5 billion worth of deals announced. And one of the biggest contributors to the deal making in Asia, as we know, is China. And China's economic slowdown, combined with, again, the geopolitical tensions, heightened regulatory risks, and scrutiny, persistence of high interest rates, really dampened the appetite of M&A activity. So China involvement M&A fell to a 12-year low and totaled 133 billion. It's down 23% from a year ago, and number of deals fell 17%. Australia involvement was also down 22% from last year. Japan also saw 10% decline in deal value, and it's the lowest year-to-date period since 2022. There's been the shrinking workforce, really present a long-term economic challenge that impact business strategies and M&A activities in Japan. But at the same time, it could also be a huge driver for middle market activity. And then Southeast Asia slowed down 14% by value. It's the lowest since 2015, down 12% by deal count. And I guess India was one of the bright spots, with a minimal 1.1% growth so far this year to 44% billion. And moving on to the next slide, let's take a closer look from a deal size range. It's like I said, there have been fewer mega deals or transactions over 5 billion announced in Asia so far this year. And before, last year, even if we didn't have a lot of mega deals, we did have a very active mid-market activity. But for this year, even the mid-market activity, or those that are at least 1 billion below, slowed down, which really highlights the cautious approach in the current economic landscape. So, as I mentioned, the mega deals were mostly driven from the US and Europe. Mega deals, we usually classify them as deals above 5 billion or more, and they really drive the dollar value trends of M&A over the past few years. So the big ticket deals, they continue to drive M&A headlines of the last few years, and are significantly affected by changes in the market. So they tend to drop when, the environment is challenging. So in Asia, there has only been 2 deals so far this year, combined total of 14.8 billion. It's down 67% by deal count and 77% by deal value. But if looking at, and including Asia Pacific, including Japan, there have been 4 deals, because there were at least 2 mega deals from Japan. And we'll get to that later as we look through the top deals. The deals below 1 billion, like I said, or the middle market deals, they fell to an 11-year low, as fewer deals were announced, even more from a mid-market level. I guess only the deals within the 1 billion to 5 billion category saw a minimal growth in aggregate value for this year. But then it was also quite relatively low from last year. So it's coming from a bit of a low base. So, the global economic uncertainties, including, let's say, inflation, geopolitical tensions, again, they really made companies from more cautious from pursuing larger deals, and companies might be even more focusing on internal restructuring, cost cutting, and organic growth rather than pursuing external growth through M&A.
Wow, Eileen, a lot of headwinds in there from overall macroeconomic, geopolitical instability, market volatility, interest rates. I mean, it's highly possible that announcements have put on hold for the time being as buyers wait to see how the economic picture evolves over the coming months. But guys, for our audience, if there's any of you who are interested to know which banks are leading the mid-market M&A rankings, the latest one is out and available on Deals Intelligence and the Deal Intel app on Workspace. Eileen, I think everything seems to be going down from the previous insights that you've shared. What about the cross border area? Any insights for Asia?
Sure that. So we have quite a few themes that we look at in M&A, and of course, cross-border is one of the categories that we track, which is usually considered more riskier or considered riskier in nature. So the growth also reflects the confidence in the market, where buyers have more confidence to look for targets overseas. So globally, cross-border M&A reached around 587.5 billion during the first 7 months of 2024. It was actually up 18% after a very slow period last year. And number of cross-border deals fell 23% year on year. So buyers in the US are driving this activity, and they remain active in outbound acquisitions, accounting for 32% of the global cross-border activity. And then it's followed by United Kingdom and Germany, um, with 8% and 6% market share respectively. So Japan actually ranked fourth and accounted for also around 6% of the global cross-border activity, with US as the most targeted nation by value. But notably, Japanese acquisitions in Southeast Asia have grown this year, with number of deals increasing 8% from a year ago. And Singapore has captured 60% of Japan's outbound M&A activity in Southeast Asia, while Thailand and Malaysia accounted for 23 and 13% market share. So there has been an increase in Japan's increased foothold in Singapore and Southeast Asia, stems from various factors, including there's a growing consumer market in Southeast Asia, strategic location, access to technological advancements. Japan outbound acquisitions in Singapore has actually reached around 1.4 billion so far this year, more than double from a year ago, and it marks the highest year-to-date total since 2019. Number of deals grew 41% year on year and saw the busiest since 2019. Um, sorry. Can we move on to the next slide, please? So if you can see from the top 10, China used to be within the top 10, but now because the outbound acquisitions continued to slow down after witnessing continued decline since the record high in 2016. There were a lot of headwinds that followed after the frenzy of Chinese outbound acquisitions from, the regulatory hurdles, protectionist sentiments, and to the recent to the pandemic. So China ranked below 10 as the most acquisitive nation for global cross-border activity this year, after being one of the largest acquirers during its peak in 2016. Uh, and with the progressive antitrust administration's foreign acquisitions in sectors deemed to be in sensitive sectors like tech or defense. A lot of overseas companies are looking for alternatives away from China into markets like India and Southeast Asia. which are markets that have good growing startup ecosystem. So it comes as no surprise that cross-border M&A is, impacted given by all the different factors that we've continuously mentioned throughout this presentation. And these factors really slow down the approval process. That's all playing part in making deals more challenging to execute, causing delays, or even sometimes deterring potential deals. So as these overhangs from headwinds diminishes, we do hope that activity will pick up.
Wow. It's really, Elaine, I think this is a very clear, testament about all the headwinds and all that we have been discussing again earlier. So I agree with you. Like what you mentioned, M&A tends to slow down during these times of uncertainty, and market volatility, and with the either tightening security, regulatory securities, right? It's just getting challenging and challenging, making it the more, so no wonder companies and investors, they remain cautious in executing deals overseas as well. So, Elaine, I'm also wondering, like, what about private equity activity? It significantly declined back in the first quarter as well, both globally and in Asia. But are there any significant difference now, and how is it looking like for the rest of the year?
So if we move on to the next slide, we again another significant theme that really brings in, I guess, flavor in the M&A space is private equity acquisitions or buyouts. So private equity acquisitions or buyouts was definitely a significant theme that stood out over the last few years. Again, with, as I said, with a high level of dry powder, um, there is a lot of capital waiting to be deployed. Globally, backed ac- private equity backed M&A activity, it reached around 434.8 billion. That's up 37% from the same period last year. But despite the double-digit percentage increase in value, the number of deals actually fell 43.6% from a year ago, because there were some really big ticket deals or huge deals in the US private equity buyout space. So again, as we've witnessed a lot of M&A transactions in the US, that also includes private equity buyouts. So PE accounted for 25% of the global deal making um, activity to date. It's up 20 from 25%. It's now 25% from 21% compared to last year. So, that's 25% that shows how big private equity back activity continues to be a big driver of M&A so far this year. As for Asia private equity backed deals targeting Asia Pacific excluding Japan, we saw around 58 billion worth of deals. It's also up 17% from a year ago. However, deal count also fell 45%, again, which signifies that there were a few huge deals driving the value figure, but fewer deals were actually announced from small to mid-market sizes. In Japan, we saw around 7 billion worth of private equity acquisitions. It's a huge decline of 73% from last year, which was very strong because that was also the year when we saw the 16 billion Toshiba buyout offer from a group led by a PE firm, Japan Industrial Partners, was announced. So that really bloated the figure last year and drove the huge decline to this year. And in Asia, PE deals accounted for 21% of the 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 market share, and it's the highest market share since 2021, which saw around 24%. Um, despite the decline in China M&A activity, it still is one of the most targeted markets for private equity backed deals in Asia. We actually saw 24 billion worth of deals. It's up 19% from a year ago and accounted for 42% of the private equity buyouts in Asia. Australia also saw a 54% increase. India private equity backed M&A fell 30%. and a few Southeast Asian markets like Singapore, Indonesia, and Thailand saw year-on-year growth in 2024 year to date. And as you can see in the graph, high tech continues to capture the majority of the private equity deals, both in Asia Pacific, both by value and number of deals, which accounted for 21% uh, of the market share, and it was worth around 12.3 billion. It's up 8.5% from a year ago. So high tech still remains to be very in demand. So, and then consumer products and services, industrials, and healthcare also witness increase in activity from a year ago. And we do continue to see PE fundraising activity in Asia remains high over the past few years. And again, still providing firms capital to be deployed. So, um, you know, and as these private equity and venture capital firms, it'll be raise their cash levels. It'll be interesting to see, and we continue to monitor where the capital will be deployed throughout the rest of the year, especially when the market becomes more favorable. Now, on to my last slide. So if you can just move on to the industry breakdown. So just to wrap up, again, a lot of the deal making activity are driven by, like I mentioned, mega deals, and that also translates into, of course, where the most activity in the sectors are. So from a sector perspective, by value, industrials, high tech, and financials were the leading sector for Asia Pacific, including Japan. So I wanted to include Japan for this slide because there has been quite some significant deals in Japan for the first 7 months of 2024. Industrials saw 75% billion worth of deals. It was down 25%. High tech, even if it saw the greatest number of deals, it was still down 17%. Financials was down financials actually up 4.4% from a year ago. And we did see other increases in other sectors like consumer products and services, healthcare, telecom, media and entertainment, and retail. And taking a closer look, although we don't have a slide here, but there were some subsector levels that particularly saw growth, like automobile and components around the transportation and infrastructure space, really driven by interest in electronic vehicles related components such as automotive battery makers and suppliers, and yeah, so on, and electronics and metals and mining. So although it doesn't also show in this slide, but there has been an increase in interest in related sectors that are deemed sustainable, like renewables or electric vehicle companies. There were at least 300 deals targeting sustainable companies in Asia Pacific and Japan. Although we did see a decline in value and deal count, it still has shown growth over the last few years. And again, some of the top deals that have been driving these numbers, like I said, mega deals take the headlines, reflecting a lot of the key trends and themes I discussed this year. In Asia, these are the top 10 deals that we've seen. Investors led by the PE firm PAG have bought 60% stake in Dalian Wanda's small unit, which was around 8.3 billion, and it's currently the biggest deal involving Asia Pacific and Japan, and bolstered consumer products and services up 29% from a year ago. There are a few reshuffles and consolidations in the telecom and telecom infrastructure industry with the AIS and Singtel deal. We see the ATC telecom and data infrastructure deal also emphasizing the growing demand for advanced telecom, digital services, telecom infrastructure to support the digital growth and connectivity needs. And in Japan, we have the Renesas Electronics acquisition of Altrium for 5.7 billion in cash, which it really supports the government's making efforts to improve competitiveness and boost supply chain resilience across against geopolitical shocks. And also earlier this year, Alibaba scrapped its Hong Kong IPO plans for its logistics unit, and we can see that now that instead it bought the remaining shares in the unit to achieve synergy between its delivery arm and e-commerce operations. So it's still a very challenging year for Asia, although we are looking forward to see what the rest of the year has in store, especially since we did see some minor improvements in activity for the second quarter of the year for Asia Pacific. So, after laying out the current landscape and how M&A has been affected by all these factors, I'm now turning it over to you, Thet. I'm excited to hear on how capital markets is doing.
That's right. So thank you so much, Elaine. Guys, we were supposed to have a poll in question for M&A, but I'll do that at the end of the session. So if we could move forward to the next two questions, please, two slides. Then, as per the global webinar, Matt Tool mentioned that the global equity and equity-related issuances during the first 6 months of 2024 increased by about 6%, by about 10%, and there was a decline in global IPO activity. On the other hand, DCM rate had recorded the highest first half year total volume, so to about 5.4 trillion in value. So I think it's very, very, exciting world in capital markets, right? From the declines that we heard from Elaine on M&A. So this is a different story, I think, for capital markets. So then, how is the capital raising activity like in Asia during the first 7 months of the year? And are there any key drivers or headwinds that you can share as well to our audience this afternoon? Go ahead, Dan.
Thank you, Ted. Can we go to the next slide, please? So it is a bit like you said, bonds rebounding, bond issuance rebounding, equities in decline. So if we look at equities, Asia Pacific ex-Japan equity capital markets proceeds were down 30% year on year for the first 7 months. So that's the lowest level for the first 7 months since 2013. And a large part of that is China simply being less active in especially the offshore equity capital markets, but we'll talk about that more in the next slide. The highlight this year in Asia Pacific is India. So in the past, where the past decades you used to have companies, especially in the tech sector, that would incorporate in Singapore or the US so that they could list overseas because they were not allowed to list at home because they get better valuations in the US especially. But in the last few years, that trend has reversed, and you've had companies like Pine Labs, Grow, Flipkart's rumored to be doing a reverse flip, they call it, where they were incorporated overseas and they're undoing that to list in the Indian stock market because the valuations there are almost as good as the US. The way the US tech stocks are going, it's going to converge, perhaps. So, and there's all kinds of other benefits from being in your home market, more recognition from investors. So that trend has reversed, and we see that continuing. There were 2 IPOs underway this week when the sell-off happened on Monday, and they both seem to be okay. Ola Electric, an electric vehicle company, and Brainbees, an online retailer. Those deals are unaffected, may affect their secondary trading performances, but there's been plenty of demand. They're oversubscribed. So you would have expected market turmoil like we saw on Monday to derail some of these, but that shows the strength of demand in the Indian market. Elsewhere, South Korea and Japan, they've been implementing corporate reforms to try to raise equity valuations and encourage things like unwinding cross-shareholdings. So you've seen a few block trades from car companies, things like that, to try and offload some of their smaller holdings and maybe unlock value in the companies. So that's triggered a bit of block trade activity. But Korea, on the other hand, has implemented some rules that make equity transactions a bit difficult and make the market a bit less liquid. So Korea has just last month implemented a rule that you have to, insiders, which would be management or directors with more than a 10% stake, have to disclose 30 days in advance if they're doing a secondary share sale, and we'll give you various details about that. So obviously, if you know that the block trade's coming in 30 days, your view of the share price is going to adjust. It's probably going to trade down. So that makes block trades a bit trickier. And a ban on short selling individual stocks also is reducing liquidity and just making it a bit harder for funds to take positions. Elsewhere, Taiwan was benefiting from the tech boom, the artificial intelligence boom especially. You've got a lot of high-tech names there. That might have changed a bit this week. So there was a pipeline of issuance that we were expecting from companies like Global Wafers, WT Microelectronics. They were doing things like GDRs, convertible bonds. Honhai has mandated for a convertible bond. So they were getting good valuations from US investors especially, but the 8.4% sell-off on Monday might make that a bit harder. Elsewhere, we mentioned a Honhai CB. Other companies in Asia Pacific have been looking at equity-linked bonds because while the cost of issuing a regular bond is pretty high with US dollar rates still fairly high, you can achieve probably half that coupon, half that yield with an equity-linked bond. And if you were hoping to sell new shares, it allows you to sell them at a premium. So we've had hugely successful deals for Alibaba and JD.com this year. Not everybody can do that. Not everybody's got the liquidity in the stock to make that cost effective or to get a good price. And also those two had coupled it with share buybacks and things like derivatives transactions to raise the effective conversion price and make it even more cost effective for them. One market that has slowed down quite a bit this year is Indonesia, which was one of the biggest global IPO markets for a while, with some companies that were connected to the electric vehicle sector. You had Aman Mineral and Harita Nickel, but ever since companies like Tesla have said that they're seeing weakening demand for EVs, then the enthusiasm has gone out of that market a little bit and the valuations have gone down. So Indonesia's gone a little bit quiet. Next slide, please. So China used to be by far the biggest part of the equity capital markets in Asia Pacific ex-Japan. So just look at 5 years ago, Greater China ECM was 67% of the volume. Now it's 36%. It's a pretty steep drop you can see there. That accounts for much of the regional ECM drop in volume. So down 64% year on year in the first 7 months. There is quite a big pipeline for Hong Kong. So we've got Midea, SF Holdings, and China Resources Beverage, which are all could be $1 billion or more. But recent listings haven't performed particularly well. So they're going to want to see some improvement in valuations before they come. In the mainland market, Asia approvals have been going slow for the last year or so. So last year, the regulators unofficially slowed down the approval process so that there wouldn't be a lot of new issuance. And if you wanted to buy A-share stocks, you'd buy them in the secondary market and it would support the secondary prices. So that seems to have been a deliberate approach there to bolster the stock market. The approval process resumed in May, but it's definitely going slower than it used to. There's definitely still some thought there about how big new deals will affect the market. One of the big ones that's been put on hold is Syngenta, the crop protection company. So that was planning an IPO that was expected to be up to $9 billion US equivalent. So first it was going to list on the STAR market, and then it seemed like it was told you're not really a tech company, you should list on the main board. And then earlier this year, they withdrew that listing as well and said they may list in China, or it could be a global market. So we're not quite sure what's happening with that, but it seemed like perhaps it was just too big for the market at the moment. And then, as mentioned earlier, Cainiao from Alibaba, that IPO's not going ahead at the moment, and Alibaba's cloud computing spin-off, it's also been put on hold. So there were a couple of big ones in Hong Kong that are not going to happen now. I mentioned Taiwanese companies have been planning GDRs, global depository receipts. So there were Chinese companies that were doing GDR issues in Europe and raising quite big sizes there. But this year, several of them have scrapped those plans. East Money and Sany Heavy have cancelled those plans because the change in Chinese regulations means there's not really any benefit to doing that compared to doing it onshore. It used to be a much quicker approval process to issue GDRs than do an onshore equity follow-on. But now it's no quicker. You still need the same approvals from onshore regulators to do the offshore deals. And it still counts towards your allowance of equity you're allowed to raise. So it doesn't really give you any benefits. And that trend has kind of stopped now. Next slide, please. So into the bond market. Last year was pretty terrible for Asia Pacific ex-Japan issuance in the G3 currencies, US dollars, euros, and yen. So last year was pretty awful. This year is up 27% year on year in the first 7 months. So it's an improvement. And part of that is the perception that US dollar rates have peaked. And also several Asian issuers have just been waiting it out, waiting for rates to come down. Now they're coming down a bit. Maybe they think it's worth doing. Also, things can get worse. You don't want to wait too long. Maybe you should just strike while the iron's hot, strike while the market conditions are okay, and you can get a decent spread. One market trend we're seeing in South Korea is that South Korea is better being treated as an emerging market. It's a AA market. Doesn't really make sense to treat it like a developed market, an emerging market anymore. So Korea Development Bank this year has been changing the way that it markets its US dollar bonds, coming out with a smaller initial price guidance range, narrowing less, and just copying what the SSA issuers do in Europe and the US, not trying to tighten by 30 basis points like a corporate might do in emerging markets deals. So they've had some success with that. That kind of gets a bit complicated because maybe Korean bonds have had a bigger share of the EM fund bucket, and when they move to developed market status, maybe they won't get such a big share, but that's a work in progress at the moment. In the high yield market, high yield went very quiet for a while in Asia. It's coming back, but it won't be China property developers issuing. They used to make up most of the market, but a couple of dozen of them are going through debt restructurings at the moment. That money's all tied up there. Investors are waiting to find out what they're going to recover from that. And that's definitely put people off the China property sector. They realize they're structurally subordinated. In the meantime, you've got Indian renewable energy companies in particular issuing high yield bonds. And those are secured against solid assets that are generating income. And you've got Macau casinos coming back as well. So that industry's pretty much rebounded. And if you're an investor, you get a pickup for a Macau casino bond compared to a US casino bond from the same company. So we're already ahead of last year's full year total in the Asian high yield market, thanks to that kind of trend. Elsewhere, we've got the Australian dollar becoming an increasingly popular funding currency. We've had issuers like Nestle making their debuts, and Canadian provinces raising quite a lot in Australian dollars. So the cross-currency swap rate's been advantageous to some of them. And it's been rivaling sterling and Canadian dollars for issuance volume this year. We've also had the rise in private credit. You seen plenty of big name private equity firms raising huge private credit funds focused on Asia. So companies like Vedanta and Adani have sometimes turned to private credit when maybe the bond market's not looking quite so accessible, but it is expensive, double-digit yields, and you put a secured against some of your prize assets. So that's available. It's kind of fitting into the ecosystem. It's not quite competing with the bond market right now. And ESG, green bonds, sustainable bonds, social bonds continue to be a big theme. So biodiversity bonds are popular with Chinese banks at the moment, and orange bonds have made their debut, global debut from IAX in Singapore last year. We've also seen a few developments in sustainability-linked bonds. So those went pretty dead last year in Asia because of new rules in Europe, which basically caused investors and issuers to rethink, are you really setting ambitious targets that make a difference? Or are you just setting targets that you know you're going to hit in 6 months? So there was that impact, making sure that the targets are meaningful. And we also had a few months ago, Enel in Italy, the utility company, was the first issuer globally that missed one of its targets at the measurement date. So the coupon stepped up on its SLB. And that has made investors and issuers realize that, okay, this is a credible instrument. People do sometimes miss their targets. It's not a sure thing that they're always going to hit it and avoid the step up. Also in Asia, just in the last couple of weeks, Thai Union Group, a seafood producer in Thailand, triggered the step down on its Thai baht SLB. So that's the first time globally we've had a step down triggered. So that's reducing the coupon. So it shows that these things actually do work the way that they're supposed to. And now the Thai sovereign is thinking of issuing a sustainability-linked bond that might have a step down in it too, probably later this year. So SLBs seem to be making a comeback. Next slide, please. And yes, let's talk about China here. As with equities, China was by far the biggest part of the Asia-Pacific G3 bond market. 60% of the volume in the first 7 months of 2019, and now it's half of that. So it's improved a little bit this year, signs of a comeback, up 28% year on year in the first 7 months, but $48.8 million, that's just a third of what they raised in the same period 5 years ago. So nowhere near back to where it was. So you've got a lot of financial institutions and local government funding vehicles still raising US dollars. Chinese banks are always going to need US dollars. It's an obvious market that they're going to attack. They're not going to stop that. Part of that will also be green and sustainable bonds. But they're doing the more expensive issues onshore. So we had the first total loss absorbing capacity bonds. So tier 3, some people call that. These TLAC bonds were issued for the first time earlier this year. ICBC did the first one, followed shortly afterwards by Bank of China. And they're raising at extremely low rates in the onshore market because onshore rates in renminbi are so low that if you're a Chinese issuer, there's just no point going out to the US dollar bond market if you don't need to. If you don't need to keep those quotas alive or keep that investor engagement, if you're just focused on price, you might as well stay onshore. And even with this new style TLAC, which is in theory slightly more risky for investors because it's loss absorbing, they only paid 2 to 3 basis points, so 10 basis points more than their old style senior unsecured bonds, which don't have loss absorbing features. So just over 2% for those issues. Just shows you how low the cost of funding is in the mainland. And as I mentioned, China high yield is stuck for now. A lot of that money is tied up in these debt restructurings, and the recovery processes are dragging on and on. So don't expect to see China high yield come back for a while. Okay, I think that's everything to talk about on the new issues, but I'll just go to the next slide and bring you through IFR. If you want to find our real-time coverage on the workspace terminal, you can find it on our own homepage, IFR, just type that in, or open the news monitor, click IFRI for the global IFR news, or IFRS for IFR Asia. Next slide, please. And you can also subscribe to IFR through the ifre.com website. The daily email briefings sent at the end of the day with all of the new issue activity in bonds and equities, or we've got our weekly magazine. So that's all from me. I'll hand back to Ted. Thank you.
Hi, thank you so much, Dan. So many interesting insights here. I've learned a lot, and of course, I follow IFR on Workspace regularly. And really, the insights that you gave me is excellent summary, of the insights that we see. But for all of you, our audience listening and watching today, there's more. And hopefully you regularly read and subscribe into IFR to get more insights on everything capital markets. So we ran out of time. I'm so sorry we don't have the time for the poll or the Q&A. We actually didn't receive questions for today, but of course you can send that over, and we will try to reach out to you to respond to any of them. I would like again to thank Dan and Elaine for all of the presentations for today, and of course for all the audience. Thank you very much for joining us for this afternoon. We will be reaching out following the webinar. You will have both the slides and the recording. And again, if you have questions, please let us know. So we are very delighted to have had the pleasure of having you this afternoon, and hopefully we will see you in another webinar. Thank you very much, and see you again. Bye, everybody.